welcome to our landlordsjournal.com podcast. This podcast was originally supposed to be aired on January the 30th, 2011, and it is titled as Cash King, Why Positive Cash Flow is Not Always Necessary. And the four of us discuss why this can be the case, not really in our area as much as it is in other parts of the country. So we are discussing that. Also, we have a new feature on our website called Ask a Landlord. You can go on the tab on the website, landlordsjournal.com, and ask us, any of us, a question, whether you are a tenant or a real estate investor, landlord yourself. So feel free to do that. Also, feel free to post in the forums. We've been attacked by some spam bots, so I'm in the process of cleaning that up. It seems to be a constant battle for that. It's something that I don't really have a good answer for to prevent. It's almost a full-time, not full-time, it's a big job just to keep the forums clean. And if anybody wants to be a moderator, feel free to contact me via email. So I'm going to start the show now. We are on YouTube now. We're going to be posting the podcast on Ustream and YouTube, and we also plan on being on iTunes soon. I'm still a little behind on doing that, but I do plan on getting that done very soon. Probably by springtime, we'll be on iTunes, so you can download us there as well. I'm just trying to find an adequate host to, because it will consume a lot of bandwidth, so I'm trying to find something adequate to host it on. So anyway, without further ado, I'm going to start the show now. Enjoy, and if you have any questions, feel free to email us or click on the Ask a Landlord tab. And we plan on having a call-in show in the near future as well, so be on the lookout for that.
Hello, America. Welcome to landlordsjournal.com. We're having another gab session here for landlords from the middle of America. Four poor boys trying to get along. We're trying to make some money by being landlords, and we've learned a lot. We've been together about 4 years. It's not working. Oh yeah, we've learned a lot, and we're gonna learn a little bit more today. I'm going to learn how having negative cash flow doesn't have to be a bad thing.
Oh, Lord.
And then I guess I'm going to write a check.
Oh, God, I needed that one.
Well, in all seriousness, why don't we say first what this concept of cash flow. Cash flow is when you have a property that the expenses are $500 and you're renting it for $600. Your cash flow is $100.
Right.
Is that right? And that's positive. You're making $100 off that property. So, if you have a property, that's expenses are $500. And you're getting $400 out of it, how is that an acceptable thing?
One word: appreciation. You're betting that it's going to appreciate in value. So this doesn't work around here. If you have a negative cash flow around in our area, you're in bad shape. But like in another places like California, that's typical to have you're lucky to just have a break-even cash flow. The lady that we bought the apartment building off of lives in California, and she said that you're really lucky to even break even as far as cash flow is concerned. In 2 to 5, 15, 10, however many years, it's going to be worth more than what your what you purchased it for. So as long as your renters are paying your mortgage and your expenses, and it's not coming, the very minimal is coming out of your pocket, you're okay. So would you spend $100 a month to gain $500,000 in 3 years in an area like California? I mean, would you? I mean, most people probably would. And that's where that all comes from, where it's okay to have a negative cash flow. Or it's not ideal, of course, but there are situations, there are times when it's acceptable to have a break-even cash flow or even a negative cash flow. But you're taking a gamble, you're taking a bigger risk. She talked about it when we went to Rehoboth Beach in Delaware.
Mm-hmm.
She talked about it a lot. That you're very lucky to have a positive cash flow. A lot of times you're in the negative. Remember that multi-million-dollar home beach house that we looked at, and we were just astonished at the cash that it did not bring in. You know? And speaking of which, well, I don't want to go off on a tangent, but yeah, you can have, and that's where that comes from. You're basically betting that it's going to go up in value. So if you're willing to spend $100 a month, to lose $100 a month, say you're in California, in 3 to 5 years or however long it takes, maybe sometimes a month, then some people are willing to spend $100.
So if you're in a market where the housing prices are going up 10% a year, and you have a $100,000 property, it's in a year it's gonna be worth $110,000. And if you're losing $100 a month in your net cash flow, you'd lose $1,200, but you would have a property that's worth $10,000 more.
Right. Well, you could even do it if there is no appreciation. Even with no appreciation, if you're looking at $1,000 property, if you're let's say you're bringing in $1,000 a month, and your expenses are $1,200 a month, the tenant's still paying $1,000 of your $1,200 liability on that property. So even if there's no appreciation, you could treat it. It's like a savings account, and then you can still be ahead. They're still putting $1,000 toward that savings account. Yeah, you're having to put in the extra $200 to keep it afloat, but for a lot of people that are just wanting something on the side, I think that's a big difference. Is do you have something that is a hobby on the side, a place to put money, or are you doing it to build a business that's is self-sustaining? And I think that's a major difference.
Yeah, and by the time you deduct it off your taxes,
I didn't even consider the tax
implications. And you don't want a huge discrepancy. I mean, you don't want something.
Well, whatever you can handle. There's a
fine line. There's a fine line where it becomes profitable and just just profitable and just being stupid. You don't want to have. I mean, sometimes it's not a good idea. There's a formula that you use.
Well, and everybody has their own circumstances. You might have money that you can't do anything with. There are a lot of investors like that have money that they don't know what to do with, and they're just looking for something to put their money in because they've maxed out on their 401k. They've maxed out on this. There are more investors like that than one might realize.
But the key is to make sure you do have money coming in. You don't buy a house and let it sit empty for X amount of years and then expect to make money. That's not the way. That's being stupid.
Yeah.
So you want to make sure you don't want to buy a house and owe $1,000 a month on it and then rent it for $250. I mean, things like that. So there's a line. There's a continuum there of being smart and being stupid with it. So you have to decide where you fall in. I mean, it's the more positive cash flow you have, the better. But I'm not saying that it's okay to rent your places dirt cheap just because you have something coming in. I mean, we wouldn't go and rent some of our properties below market value, even though we could. I I mean, there's a line there, and you have to figure that out as well. You have to figure out how much you can rent it for, and where you're being silly, and where it's not a good idea to be negative. There's a line there where you have to pay your expenses, and after you take your taxes into consideration, you have to figure out when you're losing money, because you can lose money if you're you have a house that's costing you $1,000 a month, unless it's appreciating very, very rapidly, you're losing money. I mean, if you have, like when you rehab a place before you sell it, you're losing the cost of having that place empty. I mean, you're losing money. So it's not all, rosy. What do you think, Bob?
I can visualize now where in a market such as a vacation area like Rehoboth Beach, Delaware, where there's a busy season, and then there's a season where you couldn't rent it to anybody hardly.
Right.
And so I could see where the cash flow would not be, you couldn't rent a place to have a good cash flow, or you wouldn't be looking for a place that cash flows there. You'd be looking for a place that increased in value.
Right. And it'd be easier to HELOC. After a year's time, say we took $50,000 and bought, which you can't do this in Rehoboth, but just for example, you took $50,000 and buy a beach house or something down there that's going to appreciate. If I took $50,000 one year and purchased that, down there, it could very well be worth $100,000 the next year or 2 years down the road. And you could refinance it, draw more cash out down there than you'd be able to draw out up here, So that's another advantage, where you might just break even or even lose money. You have more available money to you down there. So where we've spent $50,000 here on a house. All the houses that we buy, they're not going to be worth. They might be worth a little more. Like the one that we're purchasing now is going to be worth more.
Well, I ask your opinion. So I was thinking about timing. I was thinking about Florida. Is it better to make that kind of a judgment when the market is hot or cold?
Cold. I think, yeah. If we had the money, now would be a perfect time to start. There's people that are doing that.
Right.
They're gobbling up places in Florida left and right. A lot of people.
We talked to someone yesterday that bought two condos in Myrtle Beach.
And a
short sales.
Sale.
But then you'd have to be willing to eat those expenses.
Exactly. You'd have to
have some kind of plan.
And that's the circumstance he's actually in because of the off season.
And it works for him, but it may not work for somebody else.
Absolutely. You have to know what
you have to have your crap
Right.
together before you do it. You can't.
Right.
We're not saying you take your last dime
Right.
and go to do something like that, because like he said, he's got to pay $800 a month in homeowners association fees.
Yeah.
So there's times when he has a negative cash flow.
So we assume the overall market is going to pick up like
Right.
Florida again. And we know it is. Of course
It is. It will.
We don't know how long. It could be 1 year, 2 years.
Could be.
It will come back.
It will come
and it'll
back.
be stronger.
It's already started.
Yeah.
But now's the time to buy. I mean, now if
Yeah.
you had the money, the time to gobble those up. And of course, you might have a negative cash flow.
For
as long as you can tolerate it.
As long as you can tolerate it.
Right.
Yeah,
As long as you know what your
everybody has
tolerances
different
are.
tolerance
Right,
levels.
but you're not taking it going to the track with it. I mean,
No,
you
you
have
still got
a
a
you have an
positive.
asset there.
You have an asset.
And you're
So-
building, that money's going into a savings account.
Right.
And as long as you purchased right, I mean, you could, even in a bad economy, you could overpay for something.
Mm-hmm.
But as long as you purchased it at a good, even at a fair market value, not getting a deal, a fair market value today, in a depressed economy, will putting that money in there, the negative cash flow, will still result in, at some point, even not taking into consideration tax benefits if you don't already have property, but at some point you'll be able to get that money back, even if it's even.
I think it would appreciate pretty fast too. You can get
I
that
think
deal.
in this economy it will. I
It'll
think
appreciate fast.
based on what happened with a lot of that property, as long as you purchase it right.
I just keep thinking of all those the news reports about Florida and how many of those condos are empty, you know, and just thousands and thousands.
Oh,
There's
just
a
sitting
tremendous number of
beside each
people that
other.
are buying them. I
But
mean,
they're-
people are
they're
buying
going
entire
now.
buildings.
But I
People
mean,
are-
like last year, how they sat empty, you know, during the peak of the fall. And I know it's starting to turn around now, which is great.
I think that what I just realized is that it's something that your business as a whole, you can start looking at your cash flow, your business as a whole. And if you had, if it was the only property you had was a negative cash flow property, that would be a hard way to start. But if you had properties that were cash flowing, then you could get some of these other properties that aren't cash flow driven and support those while and use them as a bank for betting that they're going to rise in value over time.
Exactly.
And one example that we learned about last year is something that you were talking about. During the high season, it's easy to rent these beachfront properties, and during the off season, they go unrented. Well, we heard from one person that a semi-local that goes there during the off season and rents things for pennies on the dollar just to keep it, because they just want to keep it occupied and keep the utilities on. Keep the utilities on. They're getting it for a steal just to avoid expenses, and then they move out during the peak season.
That happened in Rehoboth. We heard.
That's who we were talking. That's
what you're talking about. Okay.
Is that we were told that that's what a lot of people that do there in order to maximize.
Well, and the guy we were talking to last night, he said that his places were full over New Year's Eve.
Huh.
He got like
not just his places. The
whole
entire
building.
building was full over New Year's.
Eve. You just never know. But that's what personally I would like to, and it doesn't have to be that. Like you were talking about earlier, nicer duplexes. We'll have to do a segment on that, or a show on that, about apartment buildings. But I'm over the apartment building. It's a good business model, but there's also a lot of downsides to it too, like everything. But everything.
Your
nothing's
mileage may
perfect.
vary.
Your mileage may vary, exactly. But everyone's awful quiet about this cash flow thing. No one has a lot to say about it.
What do you want? I think it's a pretty straightforward topic. The reason what other thoughts? What other aspects? I don't have any unique or.
We'll have to do a questions from the audience thing. Or we need to get that working soon.
We can't do it.
I guess it's not a
No.
no-go, I guess, to have a negative cash flow.
It's what?
It's not a no-go.
Yeah, I
it's
agree.
only for, but it is, it's for special applications.
Well, and a lot of that's not how we build ours. We are not. We are very. And part of that has to do with our local economy and our. But that's not what our desire is. We are intentionally going out of our way to purchase properties that will not put us in that situation.
Is it more of a gamble? I would say it is.
Mm-hmm.
To buy negative cash flow properties on the assumption that they'll raise in value, but it's a balance of risk, isn't it?
It does, like I said, it doesn't have to. If you can afford that, if you can afford that amount, what if it doesn't appreciate? What if it stays exactly the same, but you're paying 20% of the mortgage and the expenses, and the renter is doing 80%? You're still ahead, even if there's zero appreciation. When somebody's going to work every day to make 80% of your mortgage, if you can afford it, that's a good thing.
It'll eventually capitalize and be paid off in full, and then you have a nice chunk of cash.
That they bought 80%.
Yeah, we always assume 100% for our properties, but depending on the location, you may not need to assume 100%. I never thought about that.
And depending on how your finances are.
It depends
and
on
plus
that.
you got the taxes to consider.
And you get that benefit out of that.
Totally break even. You could potentially break even.
These people have already made. They're writing off. They purchased these starting in October. There's one's closed in October, one in December. These people in Myrtle Beach, they've already made. They're writing off 4 trips to Myrtle Beach last year.
To visit.
One of them was
close on it.
Right. Well, and you spend time there, and that's really what I would be doing is I would be going making repairs. You know.
Yeah.
I would be making repairs.
Screen door, and check the windows. And
Yep.
Yeah.
But that's a business expense.
Well, it's a legitimate business
legit.
expense,
It's
and,
legit.
and I'll just tell you, even if you just went and visited, you learn something when you're in the middle of something, when you're exposed when you're exposed to the market. He might learn something he wants to do better, or even if he didn't go there and make repairs, because they actually did. They did clean up and try to spruce it up and make it better. But I'm of the opinion that that's a legitimate expense. Now, it's not if you go there and you don't even walk in the property. That's not
Go
really.
down there and start partying.
But if you go there and you spend any time even in the neighborhood, you've learned something that could help you in your business grow. So I think it's a legitimate thing.
And they were short sales. And so, when we get to the point where we can fire up our jet and start closing on these places out of town, getting our jet and start...
fuel the jet.
Yeah. But, no, really, it was very interesting.
Just a different perspective than what we have.
It is.
Like that
And
business
I don't
model's
think
kind
he
of
had...
outside what we're doing
Actually,
right now.
even though they take 50% of the revenue in Myrtle Beach, I don't think overall for the year he'll be in the negative cash flow situation. He said come back in a year and ask me, but...
He doesn't anticipate being
He
negative.
doesn't anticipate having a negative cash flow, even with the property managers taking 50%.
Yeah, with expenses and fees,
Now,
not
you-
counting HRA, it's like 45 to 47%.
Will it cash flow in the high season?
Yeah, it should.
Oh yeah, that's what I mean.
So it offsets. the low
Overall,
season
it'll be probably
Yeah.
he's anticipating a positive cash flow
overall.
But
Yeah.
he's not.
in Myrtle Beach.
That's what he's saying. But the good thing is they went into this like I'm talking about, understanding what their ability to cover.
Exactly.
If you don't have the ability to cover something and you go into it, that's where I think a lot of failures happen. Is
Exactly.
that all the stars have to if all the stars have to align for
yeah.
you to make it, you're doomed to failure because there will be a hiccup. Inevitably. It will be a hiccup,
Inevitably.
and so that's the bad thing. Now, there are people that need all the stars to align, go down it, and they do align, and they come out. They come
I
out
don't
pretty.
have that kind of tolerance. We don't.
But it's not. They know what they can afford, and worst case scenario, they should be able to at least get their money back.
Like when we purchased the apartment building, we had it down. We analyzed it to the point where we had to have like 3 apartments rented at all times. In order for, even that's us subsidizing it. That's even 3 apartments doesn't pay the bills, but we were able to subsidize it
With
additional income that we had with still having 3 apartments rented. Because at the time, and we weren't doing as well. That's just been 7 years ago. We weren't doing as well then as we are now. So, but we had it to the point now we had it to 0. We've had times when it's been 0, but we're doing better than we were then. Now than we were then. But had we not done that, we could have set ourselves up for a lot of trouble if we didn't have the money. If we bought that building and all the stars had to align, and how'd you say that, Bob?
Yeah.
All the stars had to align. Everything had to be perfect. There couldn't be any hiccups. It had to be occupied at 90 to 100% at all times for us to make it. We would have been bankrupt, and that's happened to a lot of people.
I think if you're gonna probably simply put, if you're gonna buy a building with a negative cash flow, you got to have a lot of cash. You got to have a lot of cash.
Exactly. Exactly.
You've got to make it up. It's got to come from somewhere.
And that's often what happens is
property.
if you lose it, you might have a good job, a lot of people lose jobs, even
Exactly.
even high dollar makers that have stable jobs. Sometimes you can lose it, and that can still happen.
Yeah.
But we calculated it to the point where, you know, if something happened to Bob's job, if, you know, because my income's like all over the place. I mean, but we had to, because we had to be able to sleep at night. But we didn't. But there are people that go out, like, you know, like I said, everything has to be 90% occupancy, and you're setting yourself up.
Most of that vacation rental stuff is like that.
What, negative cash flow?
No, it's predominantly conditional upon having high occupancy during
Right.
high season.
Yeah.
That's the nature of a vacation property.
Yeah.
Because they make so much money above during the high season that that's required to carry it through the low season. I mean, not counting the expense of the purchase, they've got it on 2 units. They've got over $800, almost $900 payment per month. That doesn't take into account any utility. That doesn't take into account. Well, it does take into account utilities. It does not take into account any of the purchase price. That's a lot of money. That's a lot of money over the course of a year if you didn't have good occupancy.
Yeah.
Yeah.
Well, that one we looked at in Florida, I think, was 500 in the Birch Tower. Remember? I think it was like 5 something. But you don't have to pay a water, like you said. You don't have to. But I don't know. But no apartment buildings. No apartmentbuildings.com. No, apartment buildings do have their place. If you, that's a whole nother topic. But I'm not against them. I'm not against them. I wouldn't do it. I wouldn't do it again.
Right now, you're just
I'm burnt out.
the way your relationship with your current apartment building is
Right.
tainting
It
your.
is exactly
it
what
is.
it is.
It
That's
is.
what it is. It's not.
And it hasn't. I mean, when it's gone and out of our hair, it'll be different then even. But I mean,
We will have to talk about that.
we will, and we'll have to dissect it. And that's going to be a good show. We'll dissect it. But I don't want to jinx anything while we're in the. I want to get that over with.
Okay.
You ready for our next show? Our next show is going to be about the exciting world of real estate continuing the exciting. I can't talk today. What are we talking about next?
We're talking about gross rent multipliers
And cap rate.
cap rates
Okay.
The
on
difference
our next show.
So we'll wrap this one up today.
Okay, America. This has been another episode of landlordsjournal.com. We're gradually making our million, and I hope you guys are too. Okay, talk to you later.
Bye.
Bye-bye.
Bye.